would actually challenge maybe you to find an industry that is more hated than the gold miners, not the silver miners, not uranium, not copper miners. I'm specifically talking about gold miners. I cannot find even coal. The coal industry is actually more like than the gold miners. Cannabis, maybe I don't think so. I see much more cannabis enthusiasts than actually in the gold space. This industry is basically dead.
Inflation may be re-accelerating. Our next guest will break down the signs and implications of this trend, where you should be parking your capital in anticipation of a possible reignition of inflation. Tavi Costa joins us on the show. He is the portfolio manager of Crescat Capital. We'll be talking about a lot of different things, all the way from his macro views to mining stocks and how to allocate assets in accordance to his views. First, a word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you're over 18 and you want to open a new account with cash or roll over an existing account, click on itrust.capital/David to learn more and get started. Also, if you click on the link and register using my link, you get a $100 US funding bonus if you open a new account. So click on the link and learn about the unique tax benefits as well with using this particular IRA to park your new Bitcoin holdings, as Bitcoin has been climbing to new all-time highs and staying above $60,000 a coin. Tavi, welcome back to the show. Good to see you.
Thanks for having me, David. Looking forward to this.
Crescat Capital has put together a series of slides. Very interesting. You always have very good charts to accompany your presentation. I like to start with one that stood out to me as I was looking through this. Inflation expectations versus financial conditions. You have here two lines, the white line being inflation expectations and the red line being signifying loosening monetary conditions. First of all, how do you define monetary conditions? We'll start from there, and why these, and maybe you can explain to us why these two lines, which have historically moved in tandem, have been diverging.
Okay, so monetary conditions is defined by a series of metrics that are part of this index. And one of them is the VIX, or volatility in the market. Number two would be the credit spreads, valuations. There's some others, but essentially that gives you an idea that if those are becoming more suppressed over time, which is the case, then monetary conditions are loosening significantly. And that's been the case recently as well, with the Fed actually turning more dovish since the end of the year of 2023. And that pivoting to more dovish, to me, is highly political, number one, but it doesn't matter if it's political or not. Despite of my view on that, what's happening is we're seeing that despite the fact that inflation expectations have been rising. And I think it's political because inflation expectation is rising, and it doesn't give the Fed the justification to move from a hawkish stance. And so what I believe it's happening here is that this is probably one of the most exciting times to be an investor of hard assets, because the Fed is basically giving you the green light to invest in those assets, given the fact that they are not focused on inflation, and inflation continues to be highly embedded in the system. And so to me, that's just the bottom line of all this. And so, to see a Fed doing what they have been doing and the way they've been signaling, although we've seen recently a more hawkish stance relative to the last few months, it doesn't really change the picture. And if you want to go even fancier in terms of the macro standpoint, if the Fed is choosing to be more dovish and not move interest rates as much, let's just say we don't even cut rates, but we just stay where they are, and we see a reacceleration of inflation, that to me is a combination not only for hard assets, but also for the steepening of the yield curve. And so that's another trade that I'm looking very closely, because I think the steepening of the yield curve is highly likely in this environment.
Why is it that inflation expectations are rising despite the fact that headline CPI, and in fact even core CPI, have been stabilizing?
Well, I would say that the main reason for that is because we have not fixed the structural problems in inflation. And the answer that I'm giving to you is much more of a long-term answer than a short-term, and I'll get to the short-term. But if you don't fix the structural problems in inflation, you're not going to fix the short term either. In other words, we've been facing a chronic period of underinvestments in natural resources. And when was the last time we've seen a copper mine be developed? That's just one example. The production of oil declining and other things across even the production of agricultural commodities. We're seeing all sorts of issues in that portion or the segment of the economy. On top of that, we're seeing, to me, what is at the center of all this is the deglobalization trends escalating. And that, to me, is as inflationary as it gets, because it not only changes the logistics of countries, but it forces economies to actually revamp their infrastructure. And to me, that's another reason that will reaccelerate the demand for commodities as well. There are other issues, the reckless amount of fiscal spending. That's when you look at the fiscal deficit where it is relative to where unemployment is now, is kind of astonishing. And that's the main reason why inflation continues to run hotter than others expect. And monetary dilution. Aren't we supposed to be at one of the most restrictive monetary policies in history? Why in the world is the monetary base in the US actually rising by almost $600 billion in the last 12 months? Not only that, about $50 billion just in the prior month. What's going on? I know people technically don't want to call this QE, but the monetary base is increasing in the midst of one of the most restrictive policies we've seen in history. Imagine what that would do if we see a recession. We all know the answer for that, and it's likely to be very bullish for commodities. And so we're seeing a reacceleration of commodity prices. Look at agricultural commodities as one example. They've been surging recently, mostly driven by cocoa. And other folks are saying, well, this is just a unique thing with cocoa. No, it's not. It's spreading across the many other assets. And look at energy. Why is oil trading above $85 a barrel and starting to break out from a technical perspective recently? That's also going to create inflation. And let me point out one last thing is immigration. Even what's happening with immigration, illegal immigration in the US that has been surging. Yes, we're going to see crimes and other things, but what is that going to cause as well? Shelter cost. Those people have to live somewhere. So it's going to create a upward pressure on shelter costs again, which is the most important component of CPI. So the picture here hasn't changed. We're seeing this upward pressure in commodities recently, but I think there's a lot more to go here. And agricultural commodities itself, they're just the beginning. They're just the ones leading the pack. And there's a reason why gold is making record highs too. So there's a lot of other commodities to follow, but there are plenty signs that are very clear that inflation is reaccelerating right now.
Yeah, just on the fiscal spending, so good point. I can see how that's contributing to higher inflation expectations, especially if you consider looking at this chart that you have here. U.S. fiscal spending, excluding interest payments as a percentage of GDP. It says here, even without factoring in the cost of servicing the debt, fiscal spending alone represents over 25% of GDP in the U.S. That's a scary number, Tavi. So my first question is, well, not really a question, but an observation. If you look at what this chart shows, in past cycles, whenever we've had a spike in fiscal spending, it's usually coupled with, coincidentally, or just leading up to a deflationary event, not an inflationary event. So the great financial crisis, COVID recession, tech bubble burst, none of these things have actually seen outright inflation. So one could argue that just because we have higher fiscal spending doesn't necessarily lead to inflation. How would you respond to that?
I would respond to that. The reason why you're saying that is because we actually had a recession, a contraction that caused unemployment rates to surge. And then we've had the government spending to stimulate the economy. We haven't seen that. And the government is spending that for years, not for 1 year, not for 2 years. We're seeing this for several years now. And it's just the beginning. I think you asked me before we started, what was some of the most important things I learned in the last month or so?
Yes.
Of course, I knew about the infrastructure bill. Now, I've been looking at that myself and trying to understand where that money is going to be spent. But I never put into perspective how much today we're going to see of spending that has already been passed, by the way. The act has been passed. Relative to other periods in history, inflation adjusted. So let me give you an example. globally, after the World War II, we spent globally, not in the US only, about $500 billion to rebuild economies in the world. Today, we're talking about $1.7 trillion, especially if you include the Inflation Reduction Act, which should be included because majority of that act is actually going to go to the green revolution, the climate change ideas, and so forth. And so we're actually sitting on the verge of one of the biggest construction booms and one of the biggest infrastructure developments of many centuries, perhaps. And that is unlikely to happen without causing a major demand shift towards commodities. And when I looked at the capex for how much those commodity producers have been spending to accommodate that surge in demand, that is a major divergence between the two. That is a major disconnect in which we all know that production, producers spend money and it takes time for that to actually translate into an increase in supply. And so the risk for shortage of materials over time is really high. And so, I'm not trying to create panic or anything like that, but historically, we don't see those types of trends that don't usually cause real assets to accelerate to the upside in a major way. So,
Yeah.
I like investments that have a lot of optionality. And I think that commodities are kind of sitting in that position right now.
So let's talk about real assets accelerating. Well, actually, not even before that, not even real assets, financial assets accelerating to the upside. You have a chart here showing debt, valuation, and inflation. So the top panel is U.S. government debt to GDP, currently at over 100%. And then you have the PE ratios, the cyclically adjusted PE ratios of the S&P 500. And then the bottom panel being consumer price index on a year-over-year change basis. And it shows all three panels moving up together. Is this a coincidence or a causation, Tavi? Meaning, is higher debt causing the other two to rise?
Well, I think you can answer that in that way, and that's a fine answer. I think the other way to answer this question would be, have we ever seen this in the past? I call this a trifecta of macro imbalances. We've seen those issues independently in the past. We've seen valuations being very high in the late 90s and the late 1920s. Before the Great Depression, valuations are very extreme, similar to now. We've seen inflation running hot as well in the 70s, 1940s, 1910s. So it's nothing new. And then we've seen also debt being very extreme. Remember the 1940s, for instance, where the debt to GDP ratio was very similar to where it is currently. But we've never seen those three imbalances at once. And what that creates, in my opinion, is real political constraints over policymakers. And having them actually allow inflation to run hotter than they would like to for longer. And so when we talk about interest rates are higher for longer and all those things, I really think it's inflation higher for longer is their actual theme. And when I study back in other decades that we had inflation running hotter for longer, usually it causes investors to invest in hard assets because they have a finite amount of supply. And especially at a time when we've been through a chronic period of underinvestments in those assets. And so to me, it's really setting the stage for those things to really outperform, especially financial assets over time, and actually re-emphasizing or reinforcing the inflation trend in which, yes, inflation is going to run hotter and then it's going to decelerate and it's going to accelerate again. That's how inflation develops. This is not news. Now, I do think if we looked at this next decade and we look at the average annual rate of inflation for this next decade, I think it's going to be higher than historical standards. And so that is usually an inflationary decade. And so to me, we got to think about with those lenses about how will assets perform in an environment like that. And so that's why I get so bullish in commodities.
Okay, I do want to cover commodities in more detail in just a bit. But first, let's talk more about debt. You have another chart showing U.S. twin deficits to GDP. So adding current account to fiscal deficit as a percentage of GDP, the U.S. is now running twin deficits that are as severe as those experienced during the worst parts of the GFC. Now, again, I'm just looking at it from a layman's perspective here. Tavi, if you take a look at this chart and you pair it with, again, financial assets rising over the last 13 months or even last year or so, 13, 14 months or so, one could argue that, hey, rising deficits as a percentage of GDP are actually good for financial assets. Why would I as an investor care about this chart? Are there any negative ramifications or repercussions of the deficit widening is my question. Besides the fact that, assets are going up. Everyone wins, right?
Well, it's the destruction of your purchasing power as a consumer, as an investor, is the real issue. And yes, equities and businesses can actually go up in valuations. Again, this is very unique what we're seeing. Nobody can say with certainty what's going to happen with financial assets already at record valuations in this environment that central banks are forced to always restore back to financial repression. They may cause valuations to go even higher. But I think the easier call as an investor, you're always looking for the risk reward. The easier call is to think about what's cheap that is likely to be expensive 10 years from now, right? Investments, or I think Jim Grant has a famous phrase about this. Investing is not about what people agreeing with you today. It's people agreeing with your thesis in the future. And so if that's the case, I don't go to a restaurant or a bar and hear people talking about buying claims of natural resource projects and all sorts of things. I hear people talking about crypto. I hear people talking about AI, and all those ideas may work. I'm a contrarian at heart. And when I find plenty of reasons to be a contrarian, I will take those reasons and have high conviction to then develop a portfolio towards that. And so that's why I get excited about metals and mining and energy and agricultural commodities, because I think those things are kind of one of the meaningful, probably unfolding themes for the following decade, as we see policymakers being completely constrained because of the debt problem, because of the inflation problem, and because of the valuation problem. So your point about the twin deficits is actually very bearish for the dollar. And we all know that there's no alternative for the dollar. What's the alternative? We can all say all those things about the dollar, but are we going to use the Chinese yuan, or are we going to use the Japanese yen instead, or the Canadian dollar? All those things also look really awful. So the alternative is gold.
Okay, so why would the alternative be gold and not, I guess, equities? And we'll talk about gold equities in particular. But the reason I ask this question is because if you have deficits rising and the dollar losing its purchasing power, yes, you should invest in some sort of asset that would hedge against a decline in the dollar. But as we've seen in nominal terms, stocks have done just as well, if not better, depending on the time period you're looking at, as compared to something like gold. So why gold in particular?
I hear what you're saying. It feels like where you're trying to come from is I understand sort of the hard assets idea.
Yeah.
But why not just buy equities, because they might go up too, right?
Yeah, why not just park your money in S&P 500, leave it alone, retire in 20 years?
I'll give you the bearish thesis on equities.
Sure.
And you're welcome to disagree or ask more questions on that. I think that there is a very bearish view about equities. Think about investors. Usually you need to really consider a few things: capital flows and positioning to make a very long-term thesis very sustainable. And we know that, let's just use as an example, foreign holders of equities in the US are at all-time highs today. In fact, retesting or a little higher than what they were back in the tech bubble. We also know that during inflationary periods, what inflation causes is one major thing, which is called cost of capital to rise. And cost of capital is not just interest rates. Interest rates is one portion of that, which is the cost of debt. But there is also cost of equity. Cost of equity now, because of yields being higher, is causing companies to be forced to do what? To pay dividends. And that is cost of equity, right? And so what we're seeing is that cost of capital rising overall should also have an impact at some point on how we discount a business, because a business is valued by looking at the cash flows of that business and then discounting that back to understand what's the present value. If the cost of capital and the discount rate is higher, then the valuation of that company should be lower. Now, let's analyze this further, because as I said, this is quite unique what we're experiencing today. We've seen inflation, but never inflation with high valuations. And if we go back to the 40s or the 1910s or the 70s, and we looked at CAPE ratio as one example, because CAPE ratio has a lot of history. CAPE ratio is the cyclically adjusted PE ratio in the S&P 500 by the Robert Shiller professor from Yale. And if you looked at that data, where was the valuation of equity markets at the very beginning of prior inflationary decades? You're going to find that today we are at an unsustainable level. So maybe we're going to go even higher. But I find it very difficult to justify valuations continuing to be this high if cost of capital is likely to be higher for longer. And not only that, but maybe on the rise substantially, especially if we see other issues happening, because inflation usually causes volatility, and because it causes yields to rise. If nominal yields rise, then it creates instability with economies, because who are the biggest losers when treasury falls? When treasuries or sovereign debt falls, who are the big holders of that? Central banks. Central banks hold a big chunk of that. If their currency, think about this, if the monetary system is anchored by what they hold in their balance sheets, and their balance sheets are actually shrinking because of the value destruction of those instruments, then it creates volatility in FX markets. And that's why we're seeing central banks actually having to buy gold, is to improve the quality of those international reserves, and in an attempt to improve also the credibility of their monetary systems. We've seen this in the past. It's not news. We've seen this in the 70s, for instance, when the break of the gold standard happened, and central banks actually started a race to accumulate gold. In fact, they own about 75% of their central bank assets was actually on gold. And today is less than 20%. And so what is even more fascinating is that this pressure that we're seeing on treasuries, which is, holds the key for the entire financial system, because everything is, again, is at some point is going to have to be valued by the cost of interest rates and also cost of capital itself. And what's even more interesting about this whole topic is that we're seeing this downward pressure in treasuries, despite the fact that if you look at the data of foreign central banks' holdings of treasuries, it's at record levels. And so imagine if we actually see that number falling apart, adding further pressure on those instruments to fall apart. Because a lot of people say, China is selling. Go ahead.
Yeah, just on that note, before we move on, thanks for bringing that up, Tavi, because I've heard, I've seen on the internet people discuss this topic. The other countries are dumping U.S. treasuries and abandoning U.S. treasuries, but you're saying they're at record levels. So, why is this? Yeah, why is that?
Let me bring this is a very technical issue. So okay. let me explain this further, because if you look at China, holdings of U.S. treasuries has been declining. We know this. Just look at the data. However, and there's other central banks that are also falling. And you look at ECB or Japan, it's actually increasing, and they're making up for those declines in other economies. Now, what I think, I propose this idea to other people that you should look at is the overall amount of foreign holders, meaning central banks, international central banks of U.S. treasuries. And that number has been increasing. Now, I'm not making the case that this is bullish for treasuries. I'm making a bearish case for treasuries, because we've seen all this downward pressure in those instruments without even those central banks, overall central banks, actually dumping the actual asset. And so what's been happening, however, is that if you look at the amount of central banks holdings relative to how much treasuries are out there, because we're seeing a flood of issuances of treasuries, right? So the number of treasuries outstanding, it's been increasing exponentially because of the fiscal stimulus, because of the twin deficit, and all sorts of the fiscal agenda really causing this large amount of flood of issuances. And so if you looked at how much it's being issued and how much central banks internationally have been purchasing those treasuries, that number is collapsing, meaning we're not seeing them picking up the bill as they used to in the past. And that is a major shift. And so I think there's a reason why gold is surging and treasuries are collapsing. That break of divergence means a lot of things. One, central banks are accumulating gold. They're the ones driving gold prices higher. How do we know that? Look at GLD ETF. Why is the GLD ETF AUM, or the assets under management, not increasing? Because it's not the general investor buying gold, the central banks. Why are miners diverging from gold? Because central banks don't buy miners, they buy gold. And so now, is that going to translate into miners going up? We can get that discussion, and I believe strongly it will. But the
Isn't
main
that
point is central bank. Yeah,
isn't that somewhat a bearish argument for gold? Because, like you pointed out, gold and interest rates, specifically real interest rates, have been diverging. Historically, they've moved in tandem, in opposite directions, right? Higher interest rates usually mean lower gold. Now we've seen, real interest rates have been rising, Tavi. Gold has been rising. That's not normal. But like you pointed out, it's not because of investors buying gold and going into the gold ETFs. It's because of these central banks buying. So once they stop buying, Tavi, doesn't that mean gold is going to correct to the downside, reconverge to real interest rates?
Well, this is what usually happens at a break of a macro regime. When you say historically this has ever happened, not that I'm here to correct you, but it's only happened in the last 3 decades, this correlation between gold and real rates. If you go back to the 70s, we didn't see that correlation. And then it begs the question, why? The main reason for that is because the 70s was a period when inflation was higher than historical standards. If I am of the belief that there are plenty inflation pillars, that I usually call, that are creating this upper pressure in consumer prices for the next decade, and is likely to be the case that we're entering an inflationary decade, it makes sense, the fact that we're seeing the break of major correlations. Let me give you a few examples. I mean, it's not only the fact that we've seen sovereign bonds collapsing relative to gold. What about the Japanese yen? I mean, I'm old enough to remember when the Japanese yen was one of the safest assets out there, and it's been completely collapsing. And if you look at, gold and Japanese yen as well, they used to have a strong correlation, and now it's been broken as well. And so there are many other assets that we're seeing, or the growth versus value transition is another one that we saw back in 2021, 2022, that we're likely to see again. Why? Because cost of capital rises. It becomes it creates a need for investors to look at bottom lines and profitability, and that eventually causes value stocks to do very well. So I'm very bullish on value stocks because of that, and that creates also, potentially also a very strong thesis for emerging markets, especially resource-rich emerging markets like Brazil and South America overall. Not that I'm trying to digress, but all those things are all linked if you think about it. And the fact that gold is breaking out while real rates is moving in a different direction, it doesn't mean that gold is poised to follow real rates, or real rates are poised to follow gold. It just means that correlation is broken. And think about the 60-40 portfolios, for instance. They haven't even bought into gold yet. So basically what we're seeing is major shifts of allocation of big pools of capital. Right now, central banks are being the biggest driver, and they are shifting away from sovereign debt and into gold. And so, we're yet to see that happening with the general investor. And that when that happens, it's going to drive gold prices even higher. And as gold prices rise, it changes a lot of things. It changes the value of silver. It changes the value of copper. I've never seen a gold cycle that is not also accompanied by other commodities. And I've never seen a gold cycle that is not accompanied by the miners doing very well, because it's just logical. Thinking about a project that is producing gold, if gold prices go up from here, let's just say it doubles, then obviously that project is worth more. And so it gets you, it takes a little time for investors to kind of follow the path of all these things. But clearly we're in the direction of where, and especially at a time when the miners are so cheap, historically cheap, even relative to gold itself.
Yeah,
Which, by the way, this is not.
Yeah,
Go ahead.
on that note, that perfect segue, on that note, why is it? I mean, the most frequently asked question from gold mining investors over the last year, yeah, you know where I'm going with this. Why is it that it's so cheap? Miners are so cheap relative to gold. Another way to look at it, miners have been underperforming the gold bullion. Both the GDX and GDXJ have underperformed the gold bullion over the last 12 months. Why is that? And one last way to look at it, gold has broken to new all-time highs. The GDX is around 50% of its previous all-time high in 2011.
Yeah. And I think there are many reasons. Number one, who is driving all the purchases and the inflows in this whole industry? Central banks. What do they buy? They buy gold. They don't buy the miners. That's number one. Number two, this businesses or this entire industry arguably is one of the worst industries we've seen in a very probably in history. But it's also an industry that has its periods that it does very well.
Well, you can't just make a statement and move on. What do you mean worst? Can you elaborate on that word? Yeah.
Yeah, well, it's a capital intensive industry.
I see.
The margins are not very high. It's very cyclical depending on the metal price, but also because they get pressured by the cost to produce. And just think about to produce actually a gold or silver or copper. It takes a lot of time to develop those projects. It takes a lot of capital. It requires a lot of money from investors. And on top of it, you have issues, just general issues in the industry too. Now, there are, what I want to point out, I know all the issues, and that's already in the price. It's reflected on the fact that mining stocks are trading at one of the lowest multiples in history, if not the most egregious that we've seen in at least in my career. And so it begs the question, what changes from here? Well, first of all, it's the underlying metal. That's number one. Now, when people ask me what's the catalyst is the price of gold. Start there. But let's just take that away. Let's maybe that's not just the only catalyst. What else is out there? Well, it's an inflationary decade that drives hard assets to outperform the cost to produce. And I think that's what we're onto here. And also, the sentiment is very important. Positioning, remember, positioning, capital flows is very, very important. And where is positioning today? I would actually challenge maybe you to find an industry that is more hated than the gold miners. Not the silver miners, not uranium, not copper miners. I'm specifically talking about gold miners. I cannot find even coal. The coal industry is actually more like than the gold miners. Cannabis, maybe. I don't think so. I see much more cannabis enthusiasts than actually in the gold space. This industry is basically dead, even from inside, right? And we're seeing over conservatism. We're seeing gold rising, revenues for most of the major companies declining, deterioration across the board. And when it comes to their assets quality, why is that? The average grade of their mines is falling apart. They're not looking for new projects. In other words, they haven't been spending enough on exploration. Boy, I can go on and on and on. So why in the world invest in this? Well, it's because overly skepticism often morphs into opportunity. And inefficiency of an industry not only strives for activism, but also it's a synonym for opportunity, in my opinion. And when I see something so contrarian like this, and I can see all the clear paths that why gold could double, triple from here, then I think the miners are extremely mispriced, not only in the public markets, but every aspect of the industry, the explorers, the developers, the producers. Then why am I so focused in explorers? Because it's very simple. If you looked at the overall industry, the more early stage of the company side you go, meaning early stage, meaning exploration rather than development and production, the more it requires knowledge about geology. And I stumbled onto a chart, and there's all sorts of data about this, of how not only the capital has been going away from this industry and all the depression in the space, but also from a labor perspective. We are not seeing even young people looking to learn about geology. And so if you looked at graduates on universities and all schools and all sorts of things, you're seeing a secular decline of interest in the space. And so that is actually reflecting on the valuation of inefficiency that we're seeing in exploration. So a company, like give an example, a company drills a property and finds something very interesting. And a geologist who has been in the space for many decades will look into that data and say, they're onto something. There's a probability that has increased that they probably found a discovery. But the market is so inefficient because there's a lack of people watching this and that actually have the knowledge to really understand what that data really means and to interpret the data, that it's actually creating those inefficiencies in prices. So sometimes prices decline on good news. Have you ever seen anything like that? I mean, it's crazy. And so that's why I think it's time to take an activist approach and sort of accumulate assets that are extremely high quality that people were just giving away because they don't understand what's going on, and accumulate all those assets, in particularly at a time when I believe strongly that gold could double or triple from here, given this macro backdrop. And so that is the main reason why I'm doing what I'm doing, is because I see so many different ways where this could actually work out in a very interesting manner.
Double or triple. So $6,000 an ounce. That's in the cards.
I don't have a price target
Right.
for gold. The usual way is to think about gold
Right.
is relative to other assets. So if I look
Yeah.
at gold relative to the S&P, if I look at gold relative to any other financial asset, I can see, or don't even go to financial assets. Maybe we should just look at gold relative to money supply or monetary base globally, and other forms of monetary dilution that has been happening for so long. And so, we can go there in terms of how to value gold itself. And I don't have a target for gold, but once I see that we're making new highs relative to those things, then yes, I'm not a gold bug. I'm just a macro investor seeing this opportunity.
Well, help me understand this. If you're expecting some sort of risk-off event to occur, especially for the equities, wouldn't that translate also to the miners, especially the juniors? I mean, if there's a overall sentiment of risk-off in the markets, wouldn't people avoid more speculative assets, even if gold goes up?
Yeah, I will caution this very much so. Just this type of research that I think a lot of people actually rely on research for the last 2 to 3 decades. And, I even look at stuff, like quant models that are signaling different things. And I always ask, are you going back to the 70s, the 40s, the 1910s? Do you have data there to look at those decades? Because I don't care what happened in the last decade. I care about what happened in those periods, because that's what I think it's happening here. I don't think we're in 08. I don't think in even the early 90s. I don't think that's the environment at all. I think inflation is here to stay. And if that's the case, I want to think about with that mindset. And that's why I go back to the 70s. And the 70s was a risk-off environment. We've had several recessions. There was 3 waves of inflation, but there was also plenty of recessions during that period, in which it was a very difficult period to invest in equity markets, with many moments where equity markets declined substantially. And so that was a risk-off environment. Was it a great time to own the miners? Yes, it was. And so what does that mean? That means that we could probably see that environment today. Miners are already reflecting what you're saying. I mean, they are, the sentiment is already in the toilet.
Right.
I don't think it can be worse than what it is right now. And so
finally,
to me, yeah, go ahead.
Okay, yeah, so let's talk about silver finally. Gold, we've talked about your outlook and your thesis there. Before we get to your outlook for silver, and you have a tweet I want to show, why is it that silver has been underperforming gold? I mean, I thought silver usually outperforms gold in a bull market, which is what we've seen in the last year or so.
Well, we haven't really seen the actual bull market of gold. We're at the very early stages. Gold is just making new highs. And as it makes new highs, it's probably going to, in my view, enter a secular bull market. And how do we know that? Well, one of the reasons is because the gold to silver ratio is so high, historically high today. It's at 85, despite the fact that silver has been moving recently. 85. That's as high as it was at the depths of the global financial crisis, when gold and silver collapsed. And it was the moment for you to be buying silver, because silver went on a run all the way to 2011, one of the biggest runs of its history. And so when you ask me why silver, is because if you're a believer of the gold thesis, there's a lagging effect on silver and the miners and other commodities. But once that kicks in, once people get comfortable with gold and they start, believing in the thesis and start looking for more asymmetry, meaning better returns than actual gold, they're going to start looking at silver, start looking at the miners and so forth. And that is just a gradual move. It doesn't happen quickly. And so I wouldn't be paying too close of attention in, short-term movements in the markets. Why is gold up 2% and silver's up 1.5%? It's okay. At least it's moving up. And as we see, especially silver and yen prices making new highs, retesting the levels of 2011, if we see a move like that today in silver prices in US dollar terms, it implies a 90% move on the metal. That makes it one of the cheapest metals on earth. And I don't think it's going to stop there. I think we're going to go higher. I think there's a chance to look at silver prices in triple digits. There's a reason why and a lot of investors like to look at things after they break out, after the confirmation. That's not what I do. We purchased recently the seventh largest silver mine in the world. And the reason why we were able to do that is because no one is interested in doing that for a one-time free cash flow. Think about that. I can't even find anything in technology that trades at those multiples. And so I'm not trying to say, pat my back here and say, well done or anything like that. What I'm trying to say is you got to be opportunistic when sentiment is very bad and try to work. And we never know when things are going to turn. There's no way to know that. But you know that the foundation of that thesis, that macro thesis, is there for many reasons. On the gold side, is the trifecta of macro imbalances, the fact that gold production is falling, that we've seen in the 70s and early 2000s, central banks buying gold, deglobalization trends, the inflation decade likely entering here. All these reasons are likely to push gold higher. And if that's the case, silver is going to follow, in my view. And so that's why, to me, it's the cheapest metal on earth. And I find it hard to believe that we're going to see all this infrastructure development, all this buying from central banks without making the metals and mining industry at least more relevant than in what it is today, which is a margin error for the overall global market right now.
You tweeted, "This is undoubtedly the best looking chart I've seen in my career. One of the most important macro developments unfolding as of late. If you ask me, the silver rush is just getting started." So that's just a tweet and chart to illustrate what you've just said, Tavi. This is a counter argument I've heard from somebody else. If silver and gold have not really been moving in the same, I guess, with the same momentum over the last 1 to 2 years, the argument here is that silver has not performed as a monetary metal like gold has, meaning it's more like an industrial metal. And if you believe that, for whatever reason, industry will slow down, wouldn't that also slow down the growth of silver? Can you address this?
Yeah, I mean, it's the same idea of the miners, right? I mean, central banks are not buying, they could buy silver, and I think they will, but they're not buying silver yet. I don't think so. Otherwise, we would be seeing maybe right now with this breakout is really central banks buying. But I think that it's the same argument for the miners, is the fact that we're seeing central banks making the first move. And as they make their first move, it's creating this lag effect in other metals and the lag effect in the miners. And that doesn't mean it's the end of the world. It's one of the most bullish developments for a precious metals investor you can ever think of. And everyone is seeing this as bearish. It just blows my mind. I mean, I think we're going to look back 10 years from now and see how, I hope so, how obvious it was. Nothing is obvious. I'm not trying to say that. But I do think that the arguments are there. And I'll point out one more thing that is really interesting. It's the fact that production of silver is also falling. And if you look at Peru and Mexico, one of the largest combined producers of silver in the world, and they're down about 25% from peak levels in production. So it's the same level as it was 14 years ago. So, it's not like we're seeing a surge of supply. And we're certainly not seeing a surge of capital coming into the space, which means the supply is likely to be constrained for a long time. So it's really, supply is constrained. Now, if we know that, then it's then a demand story. And if you focus on the demand side and you know that gold is breaking out because central banks are in this need for buying it, then ultimately that should drive investors towards silver. And so you just got to be patient and try to work towards what I think is one of the best opportunities I've seen.
Final question. Any indicators we should be looking for to decide when to rotate our capital from the metals into the miners? In other words, when can we expect the miners to start outperforming the metals again?
I think the indicators that will show that first would be when general investors start buying gold and general investors start buying into this thesis. They have not bought into it yet. And the reason for that is, I think I'll give you a few metrics. The AUM of GLD. So you start seeing the the flows into that ETF is starting to rise. That means that Western societies, because they're the biggest buyers of those instruments, is starting to buy into gold and the gold thesis, and that should ultimately drive them into the miners and the silver and copper and other metals and platinum and palladium. And when I talk about silver, people usually say, well, what about platinum? I love all of them. I'm not saying it's one or another. I like all of them, but my point is those are the metrics you want to be looking at. We're yet to see the 60-40 portfolios, for instance, which there, just to simplify, there's two major pools of capital in the world. One is central banks, and the other one is traditional portfolios, the so-called 60-40 portfolios. Who runs those? That's pension funds, endowments, all sorts of things. They run those things, and they are usually today invested in something called the 60-40 allocation, which is very focused on equities and fixed income. As we see a change in this environment in which the 60-40 portfolios work in a disinflationary environment, now we're entering an inflationary era that is creating big changes of correlations between assets. As we see investors kind of understanding that shift, we're likely to see a shift also in allocations of traditional portfolios. That doesn't mean people are just going to dump all their equities and all their fixed income. That just means they're probably going to make room for hard assets, and gold is going to play a big role there. Not only gold, silver, Bitcoin, or it could be oil, it could be energy stocks. All sorts of things are going to start playing a role there too. And so it's not going to be just 60-40. It's going to be a much more diversified portfolio, in my opinion, in the future. As we see that transitioning towards that, then that's going to probably drive the miners as well, because that's general investors looking for bigger returns than just buying gold. You're not going to get rich buying gold, but and I'm not saying you're going to get rich buying the miners, but I do think the probability is much higher, and I think that is very likely to be the case for the next decade for investors that are doing their homework in the space.
Very thorough explanation of your thesis. Thank you very much. Where can we learn more about your work and Crescat Capital?
Well, thanks for having me. And you can learn more about our website, crescat.net, which we put a lot of research letters there that you're welcome to read. We have a YouTube thing that we do every Friday. It's a live presentation where we talk about macro and geology. If you're interested, just type Crescat Capital there and you can find it. And you can find me on Twitter at Tavi Costa if you're looking for more kind of a fresh content regarding macro and my views about what's happening in the world. But that's really where you can find our content. But thanks for having me again.
Yeah, and thank you for joining us. We'll speak again next time soon. Thank you for watching. We'll put the links down below, so follow Tavi in the links down below. Thank you for watching. Don't forget to like and subscribe.